Welcome to the Leafy podcast, helping real estate investors and entrepreneurs grow.
Let's start the show. Hey everybody, this is Jennifer and Brian with the Leafy podcast. Tammy's not feeling good today, so you have to put up with me almost the whole time. And Brian, he's got to punch himself in here. So today we have a really special guest. He's an investor, an author, an Inc. 5,000 entrepreneur, and the founder of Norada Real Estate Investments, a nationwide provider of turnkey cash flow investment properties. His mission is to help 1 million people create wealth and passive income and put them into the path of financial freedom with real estate. So needless to say, we love this guy already. So Let's give a hand to Marco Santarelli. Welcome, Marco.
Thank you, Jennifer. It's great to be on here. You too, Brian. It's great to be on here.
Absolutely. All right. Well, cool. Let's just jump right in. One of the things is when it comes to investing in real estate, we always kind of get everybody's point of view and like to understand your point of view when it comes to how do you successfully, someone's wanting to get started in real estate. What would you kind of suggest that they do to get started?
Well, that question by itself could literally take a full hour to go through if you really wanted to drill down. At the end, but it's a great question, because a lot of people think about investing in real estate and they start to educate themselves. Many people don't pull the trigger, and other people actually start going down the road, but they don't know exactly what their strategy and plan is. So I think the very first thing is you need to decide on whether you want to be an active or passive real estate investor. A passive real estate investor is a person who's essentially buying and holding income-producing assets, specifically income-producing real estate, because you want the passive income, you want the cash flow. So you're really not being overly active or engaged. You own the portfolio. You have people manage it. You collect the cash flow every month, and that's about the extent of it. There's some bookkeeping and accounting. Maybe you're not even doing that. The flip side of that is being an active real estate investor, and I say investor in quotes because whenever you're an active participant in real estate, it's really transactional in nature. It's more of a business than it is an actual investment, because if you're buying, fixing, and flipping properties, it's a transaction. You're flipping something. It's like trading stocks in the stock market. You're in and out, in and out. There's no residual income. So same thing with wholesaling. If you're finding deals and putting properties under contract, you're essentially flipping the contract. So again, it's very transactional. It's one and done, and there's no, stream of income. So to me, that's how I differentiate the two. And you as an investor need to decide whether you want to be an active or passive investor, or maybe it's a combination of both, because I happen to do both. But our clientele are people who come to us saying, hey, you know what? I have some capital, I have some credit, I need to build a portfolio because I want that passive income, and I need to start building that portfolio of properties that will ultimately give me my financial independence. So that's the starting point, is deciding whether you want to be active, passive, or both. And then the next thing I would do, and this can come before, during, and after, and that is just simply educate yourself, which is really, something we might end up talking about today. My first rule of my 10 rules of successful real estate investing is just to educate yourself. You need to be a perpetual student. You need to constantly educate yourself. It's just like Robert Kiyosaki, very, very successful person. But if you ever watch him in a room, he'll be sitting at the back of the seminar room with a notepad, and he'll be taking notes. Even though he knows a lot and he's very successful and uberly wealthy, he's a perpetual student. He's always learning. So if you put yourself in that mode, you will be not only more knowledgeable and more intelligent when it comes to investing in virtually everything else, but you'll become far more successful than you would if you didn't.
Now, you have a podcast that is the Passive Real Estate Investing Podcast, correct?
Correct.
So that's a great podcast, by the way. You've done like 173 episodes. I looked over, I started listening to a little bit, and I thought, okay, this is one I got to put in my queue, because a lot of people, especially beginners, when they come on, the whole idea of flipping, they watch the TV shows, and then when they think about everything they have to do, from getting relationships with contractors, understanding if it's what kind of area, it gets so overwhelming, they never make the leap, even when they see the value in their lives of choosing this type of platform for investing, rather than going to buy stocks or trading in Bitcoin or something like that. And if you go onto your website, you can also get a free download, right? The Ultimate Guide to Passive Real Estate Investing. So tell me, since this is your kind of thing, right? It is your thing, right?
Yes,
It's
it is.
good. I want to make sure. And so since it's your thing, what do you think for beginners? Is this something beginners can do if they just say, I'm overwhelmed? Because it seems to me like that would be the easiest step, right? Or
The short answer is yes. The thing is, everybody starts off as a beginner. Everybody starts off with no investment at all, no rental properties, and then they get their first one at some point in time. It could be a single family home, a duplex, a fourplex, maybe it's a partnership with somebody. But everybody starts at the same place, zero, and then they build up their portfolio at whatever speed and pace that they want. So, like I said before, the key is really to educate yourself. There's your podcast, there's our podcast, there's all kinds of resources. There's books, there's resources online, tons and tons of free content. There's no excuse not to learn how to be an intelligent investor and how to invest in real estate. Now, there's a lot of great information out there, and there's a lot of misinformation. I'm not saying bad or lies, but there's some of that as well. But when you start to aggregate content and information from multiple sources, you start to see the common denominators, and you start to realize what is truth and what actually works. And it goes back to also what I was telling you before. If you're educating yourself and you're deciding what your strategy is, I want to be a passive real estate investor, I want to build a portfolio of single family homes, I want to do this and I want to do that, and you have the team with you, the right team for your acquisitions, your property management, your asset protection, your tax your tax advice and strategy, and all those things. When you have the right team of people around you, this could be a group of like 4, 5, 6, 7 people, you are very likely to succeed and very unlikely to fail, because your team is not going to let you fail, because that's a failure for them as well. So I'm not exactly sure where I'm going with this, other than addressing your question of just learning, starting, making sure you pull the trigger. Don't get trapped in analysis paralysis, which is what a lot of people do. There's a point where you just know enough, and that's enough to get going, and you don't need to be a guru or expert. So educate yourself to the point where you're starting to feel comfortable and you get it, and then start working with a team that will help take you to that next level, that next step, because you don't need to know everything and be able to do everything. So that's really where you start, is just educate yourself and build the team.
Okay.
Well, I was reading over that you often talk about the 10 rules for successful real estate investing. Can you go over? I love that coffee cup. He just put up a coffee cup, y'all, that says, keep calm and invest on. I love that. I love that.
We actually give these mugs away for free when someone posts a rating and review on iTunes for us.
Oh,
so
nice. There you go.
We just ship
if
it.
you want a mug.
I'm peacing out on this podcast to go get my mug, y'all. No,
Ethical bribe.
I'll do it later.
It's an ethical bribe.
Yes.
All right. So what was your question? The 10 rules of successful real estate investing?
That's right.
Okay. So do you want me to just kind of roll through them, or do you want
I
specific
remember
ones?
you rolled through the first one, I think, a little bit, but I think it'd be good. Yeah, let's just roll through them all. And I think it'd be a good list for people to really kind of hone in, because I think part of it is a lot of people are finding out where to start, and I think it's great if they just had a good list to go off of. Especially
a soundbite list, because they know where to get the rest.
Yeah. So I'll highlight them all, and if you want to drill down into any of them, just interrupt me. But the first one is, like I said before, educate yourself. This is the starting point, and it's number one for reasons, is because you really need to generate a foundational base of knowledge for yourself, so you can work with the right people, ask the right questions, and you can become a good real estate investor. And if you're already a good investor of any kind, you can take yourself from being good to great. So it just magnifies your success and accelerates the speed at which you accomplish what you want to accomplish. I like to say that your confidence is a function of your competence. So how do you increase that? You educate yourself. So once you've done that, what you'll do in parallel with that is you'll set investment goals. And I know a lot of people hear this, but most people don't actually write them down. But you got to be clear about what you want to achieve. You got to make it specific, quantifiable, measurable, attainable, realistic, and timestamp it. You know, what are you going to accomplish either this week, this month, this quarter, this year, or in the next 3 years? And if you can be clear about that, you can break that down into a step-by-step action plan. And if you can just fool yourself by checking the boxes of what you need to do each and every day, week, month, etc., you can't help but to get to your final goal, because you're literally walking yourself, or figuratively walking yourself down the path of achieving that goal. But goals are very powerful, and it's been proven statistically time and time again that people who actually write down a very clear, specific, measurable goal are highly likely to achieve it or come close. Whereas the people who don't do that often don't get anywhere or very far. So there is power in the written word, and to actually be clear about something, and write it down and read it every day, or at least every week, will do something. It just triggers some energy in the universe to move you down that road. So the third rule is to never speculate. We've seen a lot of this happen back in the early 2000s, like 2004 or 5 and 6, when people were buying properties looking for capital appreciation, thinking they were investing, but really they were speculators, not investors. They were looking for the capital gains because their idea was to hold it for 6 months, 12 months, 24 months, and flip it, and then pull out a chunk of cash. And many people did that very successfully and made a lot of money. But there were a lot of people, and we're talking 1 million plus, that got caught with their shorts down, holding these properties because they were upside down. They had negative equity, and there was no cash flow, no positive cash flow. And so they couldn't hold on. There was no sustainability. Cash flow is king, and that's really the fourth rule. You invest for cash flow. It doesn't mean that you're not going to get equity growth or appreciation. Sure, that will come in time if you invest intelligently, meaning in the right markets, the right neighborhoods. It's cash flow positive. You've got the right team around you. So if you invest prudently, objectively, and rationally from the get-go, the equity part of it will take care of itself. It just will happen over time, because you have the amortization of the loan growing your equity, and you have appreciation, which is just going to happen naturally because of inflation. But when the cash flow is there, it's what I call glue. It's the glue that keeps your deal together and allows you to grow the equity and your net worth over time. Meanwhile, you have an immediate rate of return. It's called, positive income. It's cash flow. It's a real rate of return. So you don't want to speculate, but you do want to invest for cash flow. And if you do that, that actually makes you an intelligent and successful investor. Any questions about that so far?
No, I'm like sitting here trying not to be too obvious, taking notes.
Writing it down. Yeah, I mean, it's great that, I think that's great advice. It's all very solid. The writing of down your goals and stuff, I know a lot of people like to use like applications or something like that. Is that something that someone that you found doesn't work, or does work depending upon the person? Or
when you say applications, you're talking about like mobile apps or something different?
Yeah, like a mobile app, or like a Asana or something like that, somewhere where they have some piece of software to track their goals versus writing them down. Is that something that you find the writing just kind of locks in a little more subconsciously, or?
I think you should use whatever you're going to use. In other words, use whatever will be accessible and you will put to practice. Like call it old school. I mean, it's still technology, but I literally just write it out in a spreadsheet. I'll have a different section for business, finance, health, forgot spiritual. There's another one, a fun, like just a fun category. And then I'll just write, 2-3 goals in each one, whatever it is, and I color code it, and then I just refer to it from time to time, and I update it a minimum of every year, but sometimes I'll tweak it during the year, and then I can just print it out, and I used to put it in my wallet, but now I just print it out as a PDF, and I put it on my iPhone, so it's now digital instead of paper.
Got it. Okay.
So very simple, very old school, but it works.
I love that you add the other things, including your health, spiritual, and fun, because this is definitely a type of career choice for those people who do it. It's a business. You're going to have a new business. It's a new career choice, but get excited about it. If you're listening to this, be excited about the opportunity to make your business plan one that includes the things that are also so important for you to being happy and healthy and successful. It isn't just about the money with this. You know, it's great, but you can really move this around how you do your real estate investing business to feed you on so many different levels. And I love that you brought that up, that you're able to do that. And I think it's just so important.
Yeah, yeah, you need to have some sort of balance. I'm not saying a true believer in absolute balance, but a wheel has to have all the spokes. So if you don't have all the spokes, you don't have a wheel, nothing will roll. You'll have a flat side. So you'll just have one spoke or two. But if you have the whole thing together holistically, your life will roll a lot more smoothly.
Yeah.
So.
Absolutely.
So where was I? Okay, so number 5 is a big one. It was a big one for me, investing in from Southern California. Back in 2003, 2004, investing 2,000 plus miles away. In markets that were new to me at the time, and I was flying out there to build my team and invest. But I built up a portfolio very quickly in 2004. From over 2,000 miles away, but I wasn't married to any market. And that's really a principle that I had early on. And as a company, we've adopted, because we're now in 22 different markets. But the rule is to be market agnostic. And that simply means you're not married to any market anywhere at any time, because all markets move independently of each other. They all have their own economics, supply and demand factors, affordability, drivers, and story. So with a country having close to 600 plus metropolitan statistical areas, if you include the micro markets, really it's over 400 major markets. You have to understand that what happens in, let's say, San Diego, California is going to be much different than what's happening in Indianapolis, Indiana, and that's much different than what's happening in, let's say, Jacksonville, Florida. So you have to look at a market as a local phenomenon. In fact, you could easily show that real estate is not just local, but hyper local, because what happens in a suburb or even in a neighborhood is different than what's going to happen across that same city or town, at that same point in time. So you want to invest in markets that make sense from the get-go, and realizing that you may live in an expensive market, like we all are here in Southern California, very pricey. It's very hard to invest here. It's very hard to generate a cap rate or a rate of return, or even a favorable cash flow with a large down payment. So knowing that you can do much better in other markets should be a wake-up call for most investors who are under the false belief, and this comes from a lot of gurus, that you should invest within an hour or 2 hours of where you live. That's flawed advice unless you're an active, hands-on flipper looking for deals locally to buy, fix, and flip. So if you're investing prudently for cash flow, you got to look elsewhere.
Yeah. So is that one of the benefits of being a passive investor, is that it's a lot easier to invest in different markets across the US or even in the world?
It's not that it's easier. If you've got investment capital, your objective is to put that capital to work and have it generate the highest rate of return and the most cash flow as possible. So if let's just take a hypothetical example using the equities market, the stock market. I use this example a lot. If I do research and I determine that Coca-Cola is the best company to invest in terms of dividends for cash flow and long-term growth, I happen to live in Southern California, am I not going to invest in Coca-Cola because their head office is in Atlanta, Georgia? That would be just silly. And it's the same mentality with real estate investing. If I know through my research that the best opportunities happen to be in, let's say, the south side of the greater Chicago metropolitan area, which happens to be a phenomenal market, and we have a lot of clients buying rental properties through us in that market. High cash flow, strong rates of return, et cetera, et cetera. Well, if I live in Southern California, or regardless of where I live, if I don't live in the greater Chicago area, am I going to hold myself back and say, no, I can't invest there because I don't live there? Well, that's just stupid. I'm basically just taking the opportunities off the table for myself. So be market agnostic, because when you understand that you should really only invest in the markets that make the most sense at that time, because that's going to give you the greatest opportunity, both immediately and long term, that's really how you should invest as an intelligent investor. The rest of it's just psychological. If you're not investing beyond your backyard for any other reason, then you're really limiting your opportunities. Does that make sense?
Yeah, makes
absolute sense.
Absolutely.
It also is scary for people. The idea of you need when you do your homework, there are many groups, there are meetups, there is Bigger Pockets, which is a great community. There are all these places you can go to meet people and talk it out and to learn about it. There's no reason to lose money because it's not, an hour away. So I know that it seems maybe daunting for people. They get worried, that's so far, and what if something happens? But really, you're diversifying. So if I wanted to invest in my local market, Galveston, Houston area, well, we have hurricane season. Imagine if all my properties were somehow subject to a major natural disaster. And this does happen. Every 20 years, we get something, right? So now all of your properties, all of your rentals, or all of your flips, I mean, it can be devastating if you don't diversify. So you're going to want to eventually, if you get into that business, think about a couple properties in different places, if only for that one reason.
Yeah, and the thing is if you have a hurricane or a fire at your property, I don't think it makes a difference whether it's down the street from your house or 1,000 or 2,000 miles away.
Right.
You're not going to stop the hurricane, and you're not going to stop the fire because it's already going by the time you find out about it. So you're going to call the fire department, or you're going to call your property manager. You're not the one dealing with it. So the fact that it's local is purely psychological. It's just going to make you feel good because you can drive by it every morning on your way to work and see that it's still there and hasn't burned down. But at the end of the day, you're really not affecting anything. All you're doing is you're limiting your opportunities and your options by forcing yourself to invest locally when you could be doing better, 100 miles away, 1,000 miles away in a market that makes far more sense.
Right.
Absolutely.
So that actually kind of segues, to the sixth rule, and that's taking a top-down approach. So if you're market agnostic, then you're going to look at the markets that make the most sense right from the get-go. And that's all about the health of that housing market and the local economy. And the things we look at are, jobs, job growth, the level of unemployment, and the population growth. Is the population growing? Because all those things increase demand. And as you have increased demand, like more people, you have a need for more housing, for sales and rentals. And so that, not only keeps property values up, sometimes it actually increases your property values, but it keeps rents up, and it keeps a large tenant pool available for you to keep your property occupied all the time. So those are the dynamics that we look for in a particular market. So you start with the market, and then you work your way down. Once you've identified the market that makes the most sense for you because it's got the right amount of cash flow versus, future growth potential, now you start looking with your team, of course, and that could be us, it could be, your local broker, it could be whatever, your acquisitions person. You start looking at the sub markets, and then the neighborhoods, and you can quickly identify, especially if you're working with the right people, where the greatest opportunities are in any local market. And once you've identified the market, the suburbs, the neighborhood, now you start looking at the properties. And that's really where a lot of investors make a mistake, is they get presented a deal, and the deal is all about this property on this street with these numbers. Here's the pro forma, or maybe it's leased, and here's the actual numbers since, the last 12 months.
Right.
And they get tied to that, and they don't put a lot of weight or time or energy into looking at the local area, like the neighborhood that it's sitting in, as well as the greater market, to see what is going on. Is there gentrification, or is there population decline? You got to consider what's going on. So don't look at just the tree, look at the forest, because the forest is going to dictate the future health of that tree. So that's the best way to look at this. And that's really taking a top-down approach. And ultimately, at the very end of that, that line of thinking is the team you surround yourself with to help you select and manage those properties that you're buying.
Okay. Yeah, that's great to know. Are there certain red flags you're looking for when you're looking at a potential property to invest in?
Well, I want to make sure that it is either new or like new. In other words, I don't want deferred maintenance. I don't want large capex expenses. In other words, I'm trying to avoid as repairs and maintenance as much as possible. You know, there are mechanical items and things that will wear and that'll have experience wear and tear. You budget for that. That's part of your pro forma. You're going to budget for that, you know, every month and every year as part of your you know, your operations of holding these properties. You'll always have something in reserve, and you'll budget for future expense, capex expenses. But generally speaking, I don't want deferred maintenance right from the beginning. Also, I want to be in good neighborhoods. Like I've had properties in like C plus neighborhoods, and they're okay, you know, a little more transient, but and problematic at times because you're dealing with typically with lower income individuals. But, you know, my favorite is typically properties in like B plus, A minus type neighborhoods. I don't need to be in premium areas. I love them, but your cap rate and your cash flow suffers being in a top tier neighborhood. So the sweet spot is like a B plus, A minus type of neighborhood, just depending on you as an investor and what you want and need to make you feel good and you know, help you achieve your goals.
Do you suggest doing multifamily homes or single family homes, or, you know, with someone starting out, or what you guys are looking at when you're investing?
Well, again, that's going to depend on you as an investor and what you feel comfortable with and where you want to start. And oftentimes that's dictated by your, you know, your available investment capital. But as a general rule of thumb, I actually prefer and recommend single family homes because they're very abundant, easy to understand, easy to acquire, easy to dispose of. You get maybe anecdotally speaking, the greatest quality tenant living in there because there's pure privacy. You have 4 private walls. There's no one above you, no one below you. So a single family home is just the ideal living unit. And so you tend to attract better quality tenants and families. The larger the scale, you know, when you get to duplexes, triplexes, fourplexes, and certainly multi-units, you know, in the apartment space, you tend to have more of an apartment type of tenant, you know, an apartment dweller. They may not be, they don't typically have as high an income as the single family home investor or tenant. But to me, the important thing is that I want good, solid tenants that stay for as long as possible. I don't want the turnover. The turnover is the expensive part. You don't want vacancies. So if you can get a tenant that stays for years on end and they take care of the property, and people who stay in homes actually have a tendency to take care of the property as if it was their home, like their property, then, you know, that's a winning formula. And I feel good about that. So I have a preference for single families, although I've invested in apartments and I like them, but it's just a different product within the asset class. Awesome. So you know, my 7th rule is really diversifying across markets. So you've taken a top-down approach because now you've identified a market. But at some point, once you've built a footprint in that market, what you'll want to do is start to diversify geographically into other markets, and that usually means another state. So I may start off in, let's say, Houston, Texas, and then I may have 3 to 5, maybe 7 properties there, and then I'll diversify into another market, let's say the greater Chicago area or Indianapolis or Jacksonville, Florida, whatever it is, you know, that's going to meet my goals and help me diversify and protect my portfolio. But just diversification simply means that you're not in a different asset class, you're just in a different location. Because again, every market is local, and what happens in one real estate market is different than what happens in another real estate market. And that's just the way you can achieve some level of diversification within this asset class.
Right.
You know, I've mentioned this a few times. So, you know, that 8th rule is to make sure that you're using professional, full service property management. Unless you're managing it, which most people won't do on their own, and I don't necessarily recommend that most investors do, and that is manage their properties. So have full service professional management, oversee everything and take care of all your assets, and you're really just the manager of the managers. And you just keep an eye on things, keep your finger on the pulse, just look at the, you know, your cash flow and your key performance indicators. Let them handle the month to month and sometimes the day-to-day type of stuff. The most important function that a property manager really takes care of is the proper screening and qualification of your tenants. Because if you get good quality tenants placed, rents are always paid on time. Often those are on auto pay anyway, but you get your rents covered. You have very few, if any, tenant calls. It's just a matter of them doing a regular inspection once a year, maybe twice a year, and that's about it. So it is, it's just the cost of doing business. You budget for it; it's in there. So it's not like it's an extra expense. It is your expense, part of the expenses of running your business.
We recommend this too for asset protection purposes, is to have arm's length between, you don't want to be associated by every single renter with your property for obvious reasons. You want there to be layers between you, and also it lessens the burden for you. It allows you to grow. It allows you to scale. The last thing you want to do is have two properties. You're doing everything yourself. You can't get a third because you didn't have time or you don't have the expertise to properly vet the tenants, and you're getting called every 5 minutes for something, and you have no time and you're on a hamster wheel, and then all of a sudden you're like, man, this real estate investing is for the birds. Well, no, it doesn't have to be like that. It can be a lot easier if you get a little bit of help. You don't have to always do it on your own. And that's a very entrepreneurial mistake, because entrepreneurs like, if I need it done right, I'll just do it myself, right? It doesn't have to be that way. So yeah, we agree.
Yeah, no, that's good advice. So
when it comes to budgeting, sorry to interrupt, but when it comes to budgeting, because I know a lot of real estate investors say, oh, I just can't afford to have a property management. So when it comes to budgeting, what kind of guidelines would you suggest to someone on how much it would cost to have a good property manager to take on the property for you?
Right. Well, a general range is like 8 to 10% of the gross collected rent. 10% is what I call the street rate. But if you're working with a management company, aside from the fact that you can negotiate that rate, if you've got multiple properties, like 2, 3 or more under management with that same company, they're often willing to drop from 10 to 9, 8, sometimes 7%. I'm not suggesting you nickel and dime your property manager. You want to get, good service and full service from them. So you don't want to be, that guy that, is going to shave and nickel and dime them to death.
Right.
But, run it like a business, and, just realize that it is money well spent. It's a cost of doing business. They're there to handle virtually everything, related to that property and the tenant. They're there to make sure that you get your rents every month, and that the property is maintained in good condition. So it's really just a necessity as far as I'm concerned.
Yeah. Okay.
Okay. Well, let's get it here. Now, again, I want to tell everybody who we're talking to here, since we've been talking for quite some time. So we're talking to Marco Santarelli. He is the owner of Norada Real Estate, or Norada Real Estate, however you want to say it. We had a big discussion about this earlier. And he is the host of Passive Real Estate Investing, which is another podcast you've got to check out. We're going to have all of his links and everything here, so you can go to his website, get his free ebook, and we're about to finish up here. But we want to get to the last two, because now we're on 9 and 10 of the top 10 tips. And each one of them has been, you could probably talk for an hour on every single one of these. It's been amazing. So go ahead, Marco. Didn't mean to stop you.
Yeah, it's interesting, because each one of these could be, a 1-hour topic in and of themselves, because they open up other questions. But so we've covered 8. Now the 9th one is although it's one of the rules, it's kind of a general rule, and it's just to be a direct investor. The nice thing about investment grade real estate is you can essentially own 100% of it. Technically, with asset protection, you don't want to own anything. You want to control everything. You want, your entities to hold title to your assets. But at the end of the day, directly or indirectly, you own 100% of these assets. You control 100% of these assets. You get 100% of the benefits, and you call the shots. You're really running your own investment empire, your own investment businesses. When you are investing in a fund, especially on Wall Street, or in a partnership, and you don't know the principles, you're relinquishing a lot of control, and you're incorporating potential risks, because you don't know if the people that are operating the fund are, crooks or con artists. So you need to have a certain level of control. And the way you maintain control is to be a direct investor. The moment you start bringing in partners and investing in funds or paper-based assets of any kind, you're relinquishing control. So you can choose to leave it to yourself, or you can choose to leave it to fund managers and corporations where you introduce variables. But I like the fact that with real estate, you can maintain control because you can be a direct investor. You don't have to be, you can do both, but that's one of the benefits of real estate. Lastly, last but not least, of course, but lastly, is one of the beautiful things about real estate is you can take your investment capital and you can leverage it. It's really the only investment where you can take as little as 20% of the purchase price of any piece of real estate and borrow the other 80%. So you're using other people's money to not only purchase and control the real estate, but it leaves you with 100% of the benefits. So even though they're financing 80% of it, they're not getting any other benefit other than whatever interest they earn on that borrowed money, the money you're borrowing. So that's pretty cool, because it allows you to extend and leverage and multiply the results you can get from your savings, from your investment capital. So if I have $100,000, I could purchase a $100,000 rental, or I can purchase 3, 4, maybe 5 rental properties with that same $100,000. So it magnifies my overall rate of return. It increases my overall cash flow, the aggregate cash flow that I get from the property. And it magnifies my wealth creation, because now I'm getting tax benefits, equity growth, and appreciation across all 3, 4, 5 of those properties, instead of just one from that $100,000 chunk of cash that I had to invest from the beginning. So leverage is powerful, and real estate is the best vehicle to apply leverage with investment capital.
Yeah, I think that's a real big one. When you actually sit down and explain it, the nuts and bolts of that, and you get that through, because people are like, well, how am I going to be able to buy all these houses? And you're like, no, it's not really the way it works. What you're doing is you're helping the market by hooking up these deals. You're helping the banks, you're helping the people get into the house, you're helping revitalize an area that house isn't selling, or that house is not able to be rented. It's like the ultimate win-win-win situation for everyone, from you to banks to buyers. It's really great, So yeah, I think that number 10 is a big one. And the idea you can take the same money and multiply that, and like you said, use leverage for that in order to get financial freedom for yourself, while doing so many good works at the same time. It can't be stated enough, in my opinion. I think it's great.
Yeah, I agree. It's not talked about enough, I think.
Yeah.
And some people are adverse to the leverage because they think that all debt is bad debt. But the reality is that consumer debt, something that doesn't generate a return, is the bad debt. But when you can take other people's money, in other words, you're borrowing other people's money and leveraging that to generate income and wealth for you and your family, that's good debt. And then the question becomes, how much of that do you want? And the answer is as much as I can possibly get. So, right?
That's right.
So, if you want to listen to, Dave Ramsey, he's a good guy, but, you'll stay middle class. But if you really want to create financial independence, you have to start realizing that you have to get out of that mentality of money management and what he refers to as financial fitness. Financial fitness will keep you broke. It'll keep you middle class. Financial freedom actually comes with learning how money and investing works. And if you do that, you will become successful.
Yeah, absolutely.
Well, that is a great way to end it. We want to thank you so much for being here. And, we're going to have to cut this part out. This other phone rang. Oh, Lord. Hold on.
Answer the call. It's a business call.
No, actually, that's not the other. It comes with the internet. So I have this one phone, it just rings for no reason. I just need to turn it off, but it's like,
that's funny.
Take the hammer to it. All right.
Right on.
Okay, wait a minute. Let's see. When will it stop? Okay. So we're back. We're going to cut that up. And that was great. That's awesome. And it's a great way to end this segment. I want to thank you so much for being here. And again, to everyone who was listening, we were talking to Marco Santarelli with Norada Real Estate. And we're going to have all of the information for you to listen to him on his podcast, Passive Real Estate Investing, or to go to his website, which is noradarealestate.com, and get the free download, which is the ultimate guide to passive real estate investing. So you too can get all of this and even more. And I want to thank you guys. I want to thank you, Marco, for being here. Thank you, Brian. And I hope everybody has a great week. You listen to us on, or you can listen to us on iTunes, on Google Play, on Stitcher, on Spotify. We're like everywhere. So again, we'll have everything, all of Marco's information, and it's been another great week. Thanks, guys. Bye-bye.
Attention real estate investors and entrepreneurs. Did you know that real estate investors are a primary target for lawsuits? According to the National Survey of the Court data, 25% of Americans risk being sued in their lifetime. However, if you are a real estate investor, you have a 95% chance of being sued in the next 20 years. Leafy Legal Services helps you protect your assets and strategically grow your business and wealth. Leafy Legal Services are experts at the Series LLC and Delaware Statutory Trust, two of the newest and most ideal legal structures for real estate investors. Leafy Legal Services have the most personalized and affordable solutions for setting up LLCs. Property owners are always at risk when it comes to their assets. Anonymity is so important. If you own just a rental house and you own your home, you have to protect yourself and your properties from any potential legal issues. Leafy Legal Services have the right solutions to make sure you are happy and feel secure. They offer cost-effective documentation that suits their clients' needs. For a free consultation and ebook, visit leafylegalservices.com. They are waiting to hear from you. leafylegalservices.com.
Follow us on Facebook, Twitter, and Instagram.